All right, for this next recording, we're going to start off with question 10. And let's see where we go with that. The question 10 is looking for the gain reported by a partnership on a sale of something. Let's see what it is. It's land, contributed by Allen to a partnership for 20% interest. The partnership uses the land in its business for 3 years and then sells it for $700,000. The basis in the hands of the partnership of the land is the carryover basis for tax purposes, and that is $500,000. Fair market value was 6. All right. For purposes of the tax return, the gain when it sells for $700,000, that's going to be a $200,000 gain. The key is what type of gain is it? Because that's what the problem's asking for, it looks like. And the answer there is that since it was inventory in Allen's hands, which would have been ordinary income, let's go back to that. Allen held the land as ordinary income property, and it must maintain that. We can't escape, and inventory is equal to ordinary income tax. That's the definition of inventory, and so we can't escape the recognition of what was inventory, quote, that hot asset concept, and so the gain report is going to be $200,000 of ordinary income, answer A. That's a little bit of a tricky question. I don't think it gets that difficult on the exam. I can't swear to that, but I don't think if you're not following that, just calm down, take a relook at the textbook under hot assets, but I doubt that I'm going to get too involved in questions on the exam like that. For homework, it was good. It was fair game to keep you involved and engaged in a text. Number 11, which of the following statements are true? We have a partner may not recognize ordinary income when receiving a capital and profits interest in a partnership for exchange for services. Well, that's not only not true, it's totally false, because the answer is they probably will recognize ordinary income when receiving something in exchange for services. Again, we talked about that in class, I think, fairly well, so that should be pretty clear. B, contribution of 1245, triggers recognition. Well, again, that goes against the grain of the concept of Section 721, that it's a tax-free or tax-deferred. Carryover basis, of course, occurs, but we defer all recognition until the property is sold properly. C, when a partnership interest is given to a partner in exchange for services, the partnership can deduct or capitalize the fair market value of the services depending on the nature of the services, and that is true. The deduction could be an ordinary deduction at the time if the services were for ordinary and necessary expenses of the partnership, or it could be that the partner's services were for building something that needs to be capitalized on the books under the Internal Revenue Code's rules for capitalization, which we learned earlier in the course. And that's why we learned those earlier in the course. So we know that some things can be deducted and some things have to be capitalized. So answer C is correct for number 11. Let's try one more, see how we're doing. Identify which is another one of these, which is true. And we'll look at them and see. Partnership makes most of the tax elections. Well, we learned that. That's that entity versus aggregate. Partnerships make most of the tax elections. So since that's true, it looks like that one's going to be the correct answer. Let's just see if there's anything with B or C that we need to talk about. Let's look at C first. A partner can elect the depreciation method to be applied to the partner share of partnership's depreciable assets. No, these elections of depreciation are at the partnership level. So the partner can't elect the depreciation method. It has to be the partnership. Again, aggregate versus entity approach. Fisher Partnership is owned equally, this is letter B, by 4 individuals. 2 of the partners have year endings March 31, 2 have June 30th. The partnership has a natural business year. The partnership must adopt a calendar year for tax reporting purposes unless a Section 444 election is made. Quite honestly, I'd have to look this area up because I don't deal with it too often. As I said in class, the pragmatics is we almost always do calendar year for partnerships, and we forget, and we don't look at and the partners almost always have calendar years themselves, so we don't even get involved in this. We do know that A is true, so you can check your textbook. B is going to turn out to be false, but that's the reasons for it we'll have to skip through now. Given that I was not great on the explanation for B, I'll punish myself, and we'll do number 13 while we're at it, which is which of the following statements are true. So let's see what we got. Partnership cannot make a charitable contribution. That's not true. Partnerships can do that. Unlike, in fact, corporations we know can even do it. So entities can do it. It may not be always easy to sustain that it's charitable, but that's a different problem. They can make them. B, dividends received by a partnership from a domestic corporation are included in the partnership's ordinary income. No, that's part of the separately stated items concept. It will be separately stated. And that we covered just the other day in class, actually, one more time. Separately stated. Okay. Let's see if there's any other items true here. A partnership can have an NOL carryback, and that is true, because all the partnership does is pass through year by year its net results, does not calculate a tax on its own, and does not carry back or forward net operating losses of its own. It's the aggregate approach, and so C is the right answer. All right, more punishment for that not bad explanation on question 12, I guess it was. I'll do one more. Identify which of the following statements are true, or is true. Let's see what we've got here. The amount and character of any gain or loss is determined at the partnership level. That is true. That's the whole concept of the, even though it's separately stated, concept, it's part of the entity approach, that the gain or loss is determined at the partnership level. So let's see what's wrong with D. Of course, won't apply because we now have one that's true above, so it can't be D. B, partnership gains and losses from two different casualty thefts occur in 1 year pass through to the partners as two separate items. No, they would be put together. There's no reason to pass them as separate items. They're the same thing. It's like, suppose I had two capital gains. I wouldn't separately state each of the two capital gains. I'd put them together and separately state them. So yeah, the casualty loss will be separately stated, but you'll put everything together. There's no reason to separate them. It's sort of a I don't know how to describe this particular false part of the equation, but it's a nonsensical that we'd have to separately state them. It's like if you made two different charitable contributions, you would still add the contributions together and then separately state the total. That's the idea of why B is false. C, tax-exempt interest by a partnership is taxable to the partners. Well, if distributed, distributions are not taxable. We know that, and that makes no sense. The entity approach is not what happens here. It's the aggregate. If it's the aggregate approach, if it's non-taxable aggregate in the hands of the partnership, it's separately stated. But the concept, or rather the flavor, the non-tax exempt flows through, and so it'll be non-taxed at the partner level as well. All right, let's see how we're doing here. Up to number 15, moving right along, and I think we'll try to see if since this is a true-false deal, let's try one more before we get the calculation, so we'll do one more. Number 15, let's see, which are true. Hunter Partnership is A, has a net long-term capital gain of 4, and a net short-term capital loss of 1. For the current, the gain or loss will be netted, and the partners will include in their proportionate share of the $3,000 net long-term capital gain on their partnership. So let's see, long-term capital gain of 4, and that's net. Net short-term capital loss, and the gains or loss will be netted, and the partners will include their proportionate share. The answer to that is no, because these cannot be put together, unlike the problem above where they're really equivalent items that can be put together. Here, since we know that on the individual level, their net short-term capital gains makes a difference, and their net long-term capital gains at the individual level makes a difference to their tax return. The net of long-term and the net of short-term have to be separately stated to the partners so they can apply the correct tax approach for their tax return based on their own net long-term and short-term capital gains. So those have to be separately stated, and that goes up to that idea. So therefore, we know that A is not true. B, for tax purposes, the partnership takes a carryover basis in the contributed property. Well, that sounds like a true statement. That's the principle that we've been learning all along through this homework. So far we got one there that takes D out of the picture, and the right partnership in number C sells a delivery truck, recognizes a gain, which represents depreciation recapture. Under 1245, the $2,000 gain will retain its identity as a separately stated item. I'm not sure why this looks to be true, but the right partnership sells a delivery truck and recognizes a gain of $2,000. Okay, so that we got a gain, and which represents depreciation recaptured under section 1245. The $2,000 gain will retain its identity as a separately stated item. I'm not sure what's wrong with C, but since I know that B is a true statement, I think that there must be something wrong with B, or rather C. And at first it looks to me like a true statement. And I'm not, again, I have to think about that. So I'm going to take a break and come back and we'll finish that up to see why it is that what I'm missing there, to see why that's not a true statement. So we'll stop here. I'll pick it up on the next go-around.